the ROI channel, the channel that's obsessed with all things to do with the art and science of return on investment. And back with another stock review today. We are talking about VALE, a Brazilian super producer, major player in the iron ore space, but they also do other base metals and commodities. So we're going to get straight into it. Thanks to those who have already subscribed to the channel. If you haven't already done so, I would greatly appreciate you just hitting the like or subscribe button. And let's get to it. So for Crassus investment formula, that's our formula that we use when assessing companies for potential places in the investment portfolio that we have on eToro. We're looking for companies with low debt, margin of safety, sales growth, strong margins, free cash flow growth, and share buybacks. Some facts about VALE, very interesting company. It's been around for a long time. Revenue is expected to come in at 2.5 billion at the end of this year. Over the last 10 years, they've had 3% CAGR on their top line revenue growth, I should say, 8% on their margins or their EBITDA, so that their margins are expanding over time, which is quite good for a commodity business. It's very capital intensive. As you can see, I don't always use the 10-year period, but when you're talking about commodity producers, because they're so cyclical in nature, it's best to use a longer term time frame so that you can kind of smooth out the peaks and troughs in their earnings. Market cap is 74.5 billion, enterprise value 79.4. Price at the time of making this video was $14.79 with 5 billion shares on issue. So they went through a rough patch. They issued a lot of shares. That's the danger with some of these commodity producers. If they get over leveraged, they may seek to issue a lot of shares as a way of raising capital during the lean times. Although they did buy back a heap, over 10 billion worth last year, which is obviously a good sign and has reduced the float quite a bit. Dividend yield at current price is estimated to be around 13%, although obviously that'll be tied to the iron ore prices. Return on capital is 22% over the last 5-year average, so really quite good. They do have net debt, but their net debt to EBITDA is 0.12, which can be a little misleading. It's very low, which is a good thing, but don't forget that EBITDA next year or the year after may fluctuate along with the iron ore price. So if the iron ore price drops off a cliff, all of a sudden you'll see that ratio start to rise because their EBITDA will be dropping. Okay, key points. Commodity producer, mainly iron ore, competing with the Russians for nickel and some of the other supposedly battery metals. And so sentiment is quite low with regards to this particular company in Brazil. They have had some environmental issues with the workers, floods. They've had all sorts of ESG issues. So sentiment is quite low, which is obviously when we like to buy if it's not affecting the fundamentals of the particular company. Electric vehicles are all the rage at the moment. Over the next 10 years, there's a lot of talk about them driving the commodity super cycle, which so many people are expecting. And they would obviously, VALE would be a beneficiary of that should that come to fruition. And there's currency risk. Okay, so you've got the Brazilian real. It could go up or down, obviously, against the dollar cross rate. It could be a risk, but it could also be, in a strange way, it could be an opportunity. So if the real devalues against the greenback, then all of a sudden what you'll find is you've got a Brazilian-based company selling goods or commodities in US dollars, okay, so priced in US dollars, but their main input costs, so their leases and employee salaries and so on and so forth, mainly denominated in real. So if you were to see either the dollar rise or the real devalue against the dollar, you would see an increase in their margins from currency alone. But of course, the reverse would be true. So you need to kind of take that into consideration. This is the price action over the last year for VALE. As you can see up here, touched close on $21 when iron ore was over $200 a ton. If you ever want a picture that says 1,000 words, here you've seen, thanks to the potential crisis in China with Evergrande going bankrupt, and the expectation is that China's demand and output will decrease quite significantly over the next few years. They'll be building less infrastructure, less real estate. They'll need less steel, and therefore, of course, they'll need less of iron ore. So that will affect VALE. So the price has dropped to just over $100 DMT. So you can see a big difference between where the stock is trading now versus only a few months ago, back in August, before the word kind of got out about the Evergrande situation in China. Okay, so let's have a quick look at near-term projections. Free cash flow, EBITDA, and earnings per share listed in the left-hand column, and we've applied very conservative multiples in the middle and got implied prices for all of these, as we so often do. We take an evenly weighted average price, and as of next year, we would expect, all things being equal, to have a target price of around $17.93. Okay, so about 20% on the upside, and which is quite decent. But when it comes to these types of commodity plays, I like to use different valuations first as my kind of foundation, a safety net, and then anything else on the upside is a bonus. So we'll talk about that. The best way really is to look at the dividends. So VALE have got billions in retained earnings, so they can continue to pay out their dividend, at least in the near future, which is good. So we would look at, okay, we're mostly interested in this as a dividend play, similar to what we have gone over with the likes of Gazprom and Rio Tinto. So if you think about it this way, the logic is, well, if the dividend is safe and they're going to continue to pay really good dividends, and I'm going to get that distributed to me every quarter or every year, whatever the case may be, what if I just discount those cash flows into the future and said, well, if nothing else, if I get my required rate of return of 20% from the dividends alone, any increase in the share price is obviously just a bonus. And so that's what I've chosen to do here. So we run through some inputs. I've haircutted the expected dividend for this year because I think that for the first half of the year, with iron ore prices so high, it may not be quite so rosy next year. So I've given it a haircut. I've been arguably too conservative with the growth rate over the next 10 years. I'm going to say that the dividend is only going to grow at 3%, which is historically about the same as the GDP, okay, the broad economy as a whole. So that's probably or definitely a little unfair. In any case, from 10 years after, we have an increase in the growth rate. Target rate of return is always, for me personally, in the fund is 20%. And we need to get at least a 20% year-on-year compounded annualized rate of return. Otherwise, we probably wouldn't want to take the risk of owning a publicly listed stock. So in order to do that, we would need to buy the shares at $13.34 or below. So that's obviously the stock prices run higher than that, and so we would say that we couldn't get that dividend alone and get our required return. Okay, and we don't want to rely on the equity portion. We'll just leave that as a nice little bonus. Okay, so having said all that, what is the verdict? Normally I have a verdict slide here if you've been following the channel for some time. I've already sold the position, so we were in the position for VALE. However, what you've got to understand is that although I'm not normally a short-term trader at all, I have to take into account that IRR, okay, that annualized rate of return. So if we enter into a stock, we take a position in the equity, and we get our return and then some in a matter of 2 weeks, I then have to look at that on an annualized basis, which is ridiculous. It's like almost 800%, and say, okay, it's time to take the profits, and then we'll watch what happens. If the stock drops down again, then obviously that's a great scenario, because we can, we've done all this research. We can deploy the same intellectual capital back into another opportunity that we know well, if it's at a price that we like. So for me to enter in, if you're a copy trader that has copied the portfolio, congratulations. We had a nice gain, 36% in 2 weeks. So I've sold the position. I'm looking at, I'll keep an eye on VALE. If it drops down, we may take out another position, but I've actually got a mind now to rotate that capital into another iron ore player, which I will mention in another video. But if you take 36% return over 2 weeks and you work that out as an annualized return, it's ridiculous. So we have to take it, considering that I think it's now over that fundamental valuation, and we will roll it into another opportunity. Thank you very much for watching. If you haven't checked out the eToro portfolio, download the app and you can add us to a watch list to see everything that we're up to. That's the great thing about eToro. You can see literally the entire history of a fund manager. You can see their profits, their losses. It's all there, publicly available information. So I think that's really cool. If you like the way we invest and you want to copy our trades, no problems. Click on the link and then add your funds and hit the copy button, and you're done basically. And again, if you haven't subscribed, I appreciate you doing so if you like these videos. And if you've got any videos you'd like me to do or any questions, feel free to leave them in the comments. I really love the small community that we've got, which is rapidly growing. I've been getting some great questions on there. So thank you for that. And please do keep up the interaction. All right, guys, I'm going to leave it there. Disclaimer. I'm not your financial advisor. None of this is advice. So you need to be responsible for your own investment decisions. This is just my thoughts and what I'm doing with my personal money and the money that is entrusted to me to manage. But that doesn't mean you should take what I or anyone else says for gospel. You need to do your own due diligence and take responsibility for your own decisions. Having said that, all the best, and I'll catch up with you in another video. I hope to see you soon. Cheers.